Money, your stories, your freedom. The Peter Schiff Show.
Welcome, everybody. This is Peter Schiff on Friday. That means open lines, no guests, just callers for the next 2 hours here at the Peter Schiff Show on SchiffRadio.com. The number to call, 855-4SCHIFF, 855-4-SCHIFF, to participate in today's show. Probably could be another volatile session. Again, market's off to a weak start. The Dow Jones is now on the low of the day, down 200 points, just a half an hour or so into the trading day. Gold is up about $5 based on the GLD. It's been all over the place. It was up maybe closer to $20 at one point earlier this morning before the open. It's been swinging around a positive and negative. Silver is now down about 70 cents looking at the ETF. Gold stocks are also down, although, maybe they're down about 1.2%, so not quite as bad as the overall market. The dollar is weaker this morning despite the sell-off, although let me take a look to see if it's coming off its lows. Yeah, it is. In fact, the dollar's basically only marginally down against the euro. It's down the most against the yen. That's really the only currency. It's kind of it's down against the Aussie and New Zealand dollars as well, but up a bit, or flat. I'd say flat against the pound. And but the dollar is not rising. It has been on the defensive all morning. We got some economic data today on the GDP. They revised the most recent quarter's growth rate down 0.1% from 1.1% to 1%. Annualized. So that means the economy grew at 0.25% for the quarter, annualizing out to a full 1%. But still very, very anemic numbers. And, of course, I think even the 1% number is a lie because I think they derive that by understating the true rate of inflation. So I don't think we're really getting economic growth. We're getting a higher GDP, but I think it's really because of inflation. I don't think the deflator is large enough to deflate the number to adjust for inflation. So, yes, we got a higher GDP, but we don't really have any economic growth, which is why there are no jobs being created. And, on the point of jobs, I actually got invited to testify in front of a congressional committee next month on jobs, on how to create jobs. So it's actually the first time I've been invited to speak before Congress, so it'll be an interesting experience. I'm sure the congressmen are about to get a real earful from me when I blame the lack of jobs on Congress and the Fed and give them solutions that maybe they don't want to hear. But it also will be interesting to relay to them my own personal experiences where regulations have totally destroyed my ability to create jobs, where I've actually been fined for creating too many jobs, and how I've been forced to move much of my operation offshore, creating jobs in other countries because of the regulatory burden. So at least they'll hear, firsthand how somebody who does have a job is being so negatively impacted by regulations, and how many jobs that I have been prevented from creating by government, jobs that I wanted to create, that I was perfectly willing to fund, but government regulations, although not government regulations, industry regulations, but in reaction to government regulations. So it's all a direct result of government regulation. Also, we are preparing now for a hurricane, Hurricane Irene, which is going towards the coast of North Carolina. Category 2 is supposed to then make land and weaken, but potentially hit up here in Connecticut and the New York area at a Category 1. I mean, maybe, hopefully, it'll downgrade to a tropical storm. Although, Paul Krugman, he's looking at it from the opposite perspective. He doesn't look at this as a hurricane. He looks at it as an economic stimulus. He probably thinks that it would be better if the hurricane strengthened to a Category 5 and didn't just make its way up the East Coast, but after it came up to Maine, maybe it would kind of boomerang backwards and go back down through, the center of the country, maybe all the way down to the Gulf of Mexico, destroy a bunch of oil wells, and then loop backwards and maybe head out down to the West Coast and wipe out California, and then maybe hang a U-turn and go down, gather strength, and go down to Hawaii and level all those islands, right? That would be massive economic stimulus, according to Paul Krugman. In fact, I heard a rumor that he was kind of lamenting the fact that earthquake that hit the Washington area and it went all the way up to New York and even Connecticut and New Jersey, he was upset that that wasn't a bigger earthquake. You know, Japan, they got lucky. You know, we need a really big earthquake because we're not going to get much economic stimulus from a small earthquake. You know, it's funny, too. You look at these pictures of all these people down in North Carolina who are putting plywood on their windows. Why are they doing that? I mean, why don't they just leave everything the way it is? Because that way there'll be more damage from the earthquake, and then we'll have a bigger economic stimulus. I mean, why bother? You know, why are we trying to protect ourselves from flood? Let the flood waters ravage. Think of the boom of the economy if we just have more flooding, if we have more destruction. You know, the problem with Hurricane Katrina is it only flooded New Orleans. See, if the whole country would have been engulfed in water, well, gee, I mean, we would just, it'd just be big boom time. Right? Obviously, you can see how ridiculous this whole idea is that we can benefit the economy by destroying it. But, of course, based on the Keynesians, now, you know, I suppose he'd rather not. He doesn't want anybody to lose their life. You know, he just wants property to be damaged, you know, kind of like the old neutron bomb, right? Let's just destroy all the buildings, but not actually, that's the opposite. The neutron bomb leaves the buildings and just kills the people. So I guess we need a reverse effect. We just want to destroy all the buildings and leave all the people standing. That way the people will have a lot of work to do in rebuilding them. But anyway, the truth of the matter is the last thing that the U.S. economy needs right now from a financial perspective is a devastating hurricane that destroys assets, and now we're going to have to expend money. I mean, where does the money come from? If we have a lot of damage from the hurricane, and everybody puts in a lot of insurance claims, what do the insurance companies have to do to pay those claims? They got to sell bonds, they got to sell stocks, they got to take money from other areas of the economy and funnel it into rebuilding property that was destroyed. And rather than using those resources to add to the economy, to make new stuff that we didn't already have, we're simply using the resources to replace what was lost. So we're not better off. What would make the economy better is if nothing was destroyed and we were able to use those resources for new stuff that we didn't already have, right? Building new things, not repairing the things that we used to have, but then were destroyed by the hurricane. But anyway, hopefully the hurricane does not impact as strong, because again, the last thing we need in the U.S. economy is more damage. You know, we have a lot of problems that are man-made already. We don't need more problems that are going to come from nature. And of course, what you really need to prepare yourself for these types of situations is savings. You see, if we had a lot of savings and then we had a flood or an earthquake or a hurricane, you know, hey, we'd have money saved for a rainy day to pay for it. We don't have the savings, so we got to go deeper into debt to pay for this. We got to ask the Chinese if they'll loan us some more money so that we can pay to repair the damage done by the hurricane. Anyway, don't go away. We'll be back after this message. We'll be taking your calls, 855-4-SCHIFF, 855-4-SCHIFF. Welcome back, everybody. It's Peter Schiff here at SchiffRadio.com. You know, those of you watching on the video, the premium members, you'll notice a bit of a difference. We finally got the new camera working, so you're getting a little bit of a better quality video feed. So if anybody is watching that, maybe you want to give us a little bit of a feedback and let us know if it's a big improvement. Anyway, but this is the first day we've gotten the camera to work. And now, as a matter of fact, I now have the equipment here in this home studio so that the next time I do a television show, whether it's a CNBC or a Fox, that I should be able to do it from right here. So I'll be able to do some shows more often because I won't have to worry about the conflict with the radio show because it's not going to take any time to travel back and forth. In fact, I might even be able to take a 4 or 5 minute break on the show and do a television show. In fact, maybe we can simulcast it. I could be doing the radio show and a television hit at the same time. But anyway, in order to see the improved signal, you've got to be a member of Premium, a Premium member with the video option, which I think is an extra $2. So I think it brings a total to $6.95 a month if you want to be able to see as well as hear the Peter Schiff Show. Now, apparently, Ben Bernanke is speaking now. And I don't know exactly what he said. I'm going to try to look into it more on the next break. I know gold reacted positively. Gold rose to up about 22, 25 bucks, at least on the GLD. It's backing off now. It's only up about $17. Not much of a reaction. I mean, the Dow is now rallying back a little bit. I mean, it was down 140 points 2 minutes ago. It's now only down 98 points. So we are getting some volatility in response to what Ben Bernanke has said thus far. The yen has weakened a bit. It's given up some of its gains. It's still way up, but not much reaction in the other markets, although it seems like the Aussie and the Kiwi dollars are picking up a little bit of strength. But I want to examine a little bit more about what Ben Bernanke actually said. But the whole thing is, it's crazy that we give so much credibility. We wait with bated breath just for, to hear some words from the Fed. Everybody is looking to the Fed Reserve to do something to help the economy. They can't do anything. I mean, other than raise interest rates, which they're not going to do. Everything the Fed has done thus far has undermined the economy. And, of course, we're all looking for the government to do something. But the government can't help the economy by spending money, and that's the only thing that anybody wants them to do. We have to realize that the economy is in trouble because the government has already done the things that we wanted to do because we think it's going to help. It is the government cure that is why the economy is so sick, which, of course, everything works exactly the opposite. In Washington, whatever the government sets out to do, they will achieve the exact opposite. So it stands to reason if they try to stimulate the economy, they'll in fact sedate the economy. So what we need the government to do is we need politicians to do exactly the opposite, right? Just like, the George Costanza approach. They need to do the exact opposite. See, everyone in Washington thinks that the worst thing for the economy is to cut spending. So that's exactly what they need to do. Everybody thinks, oh, my God, the worst thing was if we have higher interest rates. So that's what they need to do, just raise interest rates. If everybody in Washington did the exact opposite of what they think, the economy would be in great shape, right? Because every instinct that the Fed has is wrong. Every instinct that Congress has is wrong. So they just need to do the opposite of what they instinctively want to do, and then the economy will succeed. But as long as they are doing what they want, right? They're not going to get anywhere, right? So anyway, let me go to the phones. Maybe someone who's calling who actually heard some of what Ben Bernanke had to say. But the first caller is Mark, who's calling from Calgary, Canada. Mark, welcome to the show.
Hey, thanks a lot, Peter, for taking my call. Really enjoy the show. Sorry, I'm not watching the Ben Bernanke speech. I'm sure I'll hear it ad nauseum later on from all the talking heads on TV. But had a question for you and a comment about something on Fast Money from last week. But question is on Chinese price controls, or at least implied price controls. I bought some stock in an integrated palm oil company, and they also do a bit of sugar as well. And it was over a couple of months ago, I got a media release that China had asked them, and I'm saying that in quotation marks, not to increase palm oil prices. And the company complied. And that was very concerning to me. So I was just wondering, how often do you see stuff like that where China tells a company, and this company is based out of Singapore, tells a company, we don't want you to raise prices just now, and that company feels the need to comply? Does it happen a lot? What's your strategy for dealing with this? Are there anything to be on the lookout for?
I don't think it happens a lot, and I don't think that that the company is going to follow through with that for any length of time. Maybe symbolically it can hold off on a price increase, but ultimately it's going to have to happen. The Chinese government knows this, and the thing is they cannot control inflation by trying to focus on prices, because prices rising are the result of inflation, not the cause. The cause of inflation is the money printing in China, and the money is being printed to keep the RMB from gaining in value. And so instead of the RMB gaining in value, they make the RMB lose value. So the Chinese government is deliberately destroying the value of the RMB so that it won't go up against the dollar. But if they are going to make their currency worth less, then you're going to need more RMB to buy palm oil, to buy everything. And so the policy of the Chinese government is to cause inflation. So that's what they're doing. And as long as they're creating inflation, prices are going to rise. And they can try for public relations to try to, attack the symptoms, but the disease is going to continue, to grow in the Chinese economy. And the prices are going to go up. There's no way around it.
Okay, so effectively they're just trying to buy themselves a little bit of time for the,
and I think
the
it's
PR spin.
I think so, and I don't think, because they obviously have to raise prices if their input costs are going up, because the Chinese don't want to destroy these companies, because ultimately if they don't make a profit, they have to fire their workers. So, it doesn't make any sense for the government. Now, what they're ultimately going to do is they're going to give wage increases. They're going to, the Chinese are going to get higher pay, but all of this would be better achieved through a strengthening RMB. And so the Chinese just have to come to their senses. But as I said, having the dollar as the world's reserve currency is screwing up the entire global economy. We are the epicenter of the world's financial problems. It's not Europe. It's America.
Yeah, for sure.
All right. Well, anyway, hey, we're up against a break. Stick around. I'm going to try to do a little research during this break and figure out what Ben Bernanke may have said. But anyway, don't go away. We will be right back. Welcome back, everybody. This is Peter Schiff here at SchiffRadio.com. And I was able to do a little bit of research over the break. Didn't hear all of Ben Bernanke's prepared remarks. But apparently what he did not say was he didn't give any indication about any further commitment to QE3. In fact, hold on. Excuse me. In fact, Ben Bernanke gave a rather upbeat, apparently, assessment of the U.S. economy. He said it was in good shape, it was recovering nicely, the fundamentals were sound. Obviously, he's lying there. He felt that he had to be upbeat, because clearly he doesn't believe that, or he wouldn't have maintained to keep interest rates at zero for another 2 years. That is not something that you do when the economy is healthy and growing and recovering. It's kind of like if you're in a hospital and the doctor tells you, hey, I got great news, you're in great shape, you're recovering nicely, everything looks good. Oh, but by the way, we're going to have to keep you in this bed for the next 2 years on life support. We got to keep your heart and your lungs and all of your vital organs hooked up to these machines, because if we take any of these plugs out, you're gonna basically have cardiac arrest. But other than that, I mean, you're really in good shape. So clearly, the economy is not in good shape. But anyway, we're getting a lot of volatility. The stock market had been down only about 50 or 60 points at one point, even during the break. We're now back down 108 in the Dow. Gold is only up 140. The news is not bullish for gold in that we didn't get more QE, but that was the rumor. I mean, the market was selling off, which is why I said that I thought that even if we didn't get a announcement of a commitment to additional money printing, that I thought gold would rise. But gold would have risen much more dramatically had Bernanke actually laid out a plan similar to QE2. That would have just been the equivalent of throwing red meat to a bunch of lions, and I think the gold market would have risen sharply. I think stocks would be going up right now as well. So I think we would have gotten bigger reaction. So at least Bernanke did not do that. I kind of thought that he might do that, because it seems to me that he's always looking to give the markets what they want. Maybe this time he thought that there was going to be too much negative publicity from QE3. Maybe he was afraid that oil prices, which have come down a little bit, might really spike, and I believe they would have had he announced something similar to QE2, even though I believe that is the Fed's intention. They already know they're doing QE3. They just don't want to admit that they're doing QE3 because they know that the truth is ugly, and so they want to hide it as long as possible. Anyway, I'll go back to the phones. Next up, another a call from outside the U.S., this time from Australia. Jeremy is on the line from Brisbane. Jeremy, welcome to the show.
Hello.
Yes. Good day, Jeremy.
Hello.
How are you?
Oh, I'm good. I'm so pleased to be on. I've been listening to your show every night for way too long. I listen to it live. I stay up till midnight to listen to the show.
Ah, well, good for you. You know, you can subscribe to it, be a premium member if you want to listen to it earlier.
I am a subscriber, and I listened to it today to hear you call my name last night, and I had fallen asleep.
Oh, no wonder.
I missed my chance to talk to you last night. Yes, I do listen to it online when I don't manage to catch it live, but I do like to hear it live. I like to keep. It's always nice to hear things when they're fresh on your mind.
Uh-huh.
Yeah, I know there's a lot of people who are listening to what you have to say. I did have some questions. One of the questions that I had for you was if you could share some of your thoughts on the way the regulators make it difficult for you and how they choose what you can and can't say on the air. I was really interested to know if there was when you were talking about was it NIA, I think, and they were and you talked about some of the shares that they'd been pumping and dumping, etc. I was curious to know if you're aware of. I mean, I know you're not allowed to give specific recommendations, if you like, and so I guess are you allowed to do the opposite of that? Like, if there's a company that you think is going to go bankrupt, are you allowed to go around and say, well, because you should be, shouldn't you? You should be allowed to say that.
Yeah, but not really. Yeah, because theoretically, I'm not supposed to give a recommendation, and so even telling people not to buy something is a recommendation because maybe they were going to buy it and then they listened to me. So I don't give any recommendations at all to buy something or not to buy something. But I do, I am going to talk about companies that are in the news, and I can give my opinion on them. But just because I don't like a company doesn't mean I'm telling people not to buy it, right? I mean, they can maybe read between the lines and make their own decision, but I'm not allowed to do that. And that's that is part of the problem. I mean, the regulations are so onerous and so crazy, and the legal exposure is so great based on the regulations that you really can't do anything. I mean, I dance around it as best I can because I do want to talk about the markets, and when you talk about the markets, stocks are in the news, sectors are in the news, and so it's important to be able to comment on them. All I'm saying is that people should not be listening to my comments and interpret them as an investment recommendation. If they want to know what my investment recommendations are, they need to call up my brokerage firm, and they can get them off the air. We are allowed to give investment advice one-on-one on the telephone. We're just not allowed to do it over the airwaves to a vast audience where we do not know who is listening. And I suppose the regulatory framework for it is that it's suitability. As a stockbroker, I cannot give investment advice to somebody unless I know the advice is suitable. And obviously, I don't know everybody who is listening to this show. I don't know, if what I'm saying is suitable. And I could even be of the opinion that, if I say don't buy something, that's suitable for everybody. You would think, right? If I think something is a bad thing, that telling people not to buy it would be suitable for just about everybody. But I also think there could be some kind of liability if I tell somebody not to buy something, and what if it goes up? And they say, oh, I'm suing you. You told me not to buy it, and look how much it went up. So I don't know. Some of it might be that. But, I mean, It's just difficult. And yeah, I mean, and I have a lot of problems with the regulators, and that's one of the things that I'm going to talk about when I go to Congress, because I am going to talk about how many jobs I have not created because of security regulations. I mean, I would employ hundreds of additional people today if the regulators would have enabled me. In fact, many of the businesses that I have now that are offshore, I've got Europac International. I'm moving my asset management business to Singapore. All of this stuff is being motivated by regulation. Regulation is the primary driver for me trying to move assets, employees, employment opportunities, resources offshore. Yes, taxes are also an issue. I do reduce my tax liability, but that is actually secondary. I'm actually more concerned about the regulatory cost than the tax burden. But of course, they're both important, but the regulations are actually a bigger driver. And I think that's probably the case for most businesses that are moving jobs offshore. It's not the tax code that they're escaping, it's the regulatory environment. But anyway, hey, thanks for staying up late and listening live to the show, and tell your mates out there in Australia. We got to build up that Aussie audience. And remember, we do have Europac International, so if you are living in Australia and you want to do business with me, including getting the first in the world gold-backed MasterCard, you can do that through Euro Pacific Bank and Euro Pacific International. Anyway, don't go away. We'll be back with more of the Peter Schiff Show in a minute. Welcome back, everybody. This is Peter Schiff here at SchiffRadio.com. And guess what? We've got some more sound from another Nobel laureate in economics, another nominee for the Nobel Prize in Stupidity. We're building them up here. They're certainly bringing these Nobel Prize winners out by the truckload. I wonder if there are any economists who don't have a Nobel Prize. I mean, certainly none of the Austrian economists, although they did manage to give one out to Hayek some time ago, so maybe that's the last time that somebody won one that actually deserved one. I don't know. I haven't. Maybe there is somebody out there. I don't want to just insult all of the Nobel Prize winners. There could be a couple of them out there that actually know something about the subject. But anyway, obviously, this particular guy is a bit challenged. Anyway, so let me play a little sound. This is from Bloomberg TV yesterday. It's Michael Spence. And first of all, he's talking about how, the worlds are looking for the governments to solve these problems. Of course, the government caused the problems. But anyway, here he is, cut number 5.
Well, the government, it seems to be, on both sides of the Atlantic, governments seem to be unable to act aggressively and decisively, and people are worried, scared, fed up, and so on, and the Fed is kind of left there standing, holding the ball.
Yes, but he also, if you listen to the whole, we didn't get the whole clip, but he was talking about the fact that the world is waiting for the government to act decisively. But to act decisively to do what? To spend more money, to stimulate. But the economies are in trouble. Look at the problems in Europe are sovereign debt crises. That means the governments in Europe borrowed so much money that they can't pay it back. So the problem is there's too much government debt. How can the solution be more government debt when the problem is that we've got too much government debt already? It's amazing. Here's a little bit more, cut number 6.
What can the Fed do to fix things at this stage?
Well, they can continue. I mean, they won't like it in the emerging markets, but they can move to try to keep. They can certainly keep interest rates down.
Which they've said they'll do.
When they've said they'll do, and they've made a kind of time commitment now, so that's something.
So again, all he knows is, well, how do they stimulate the economy? Print money, keep interest rates down. Well, they've been down for years. That obviously hasn't worked. Now, he says one thing there that's interesting. He says that they won't like it in the emerging markets. Why not? Because it means that they're going to have to print more money, too, to stop their currencies from rising. Of course, they don't have to do it. They just think they have to do it, which means we export our inflation to the emerging markets who have to eat it. And so obviously they don't like it. But what happens when they say we're mad as hell and we're not going to take it anymore and they don't want to import our inflation? Well, then we're stuck with it, and we have to eat the inflation ourselves, literally. Anyway, I'll play a little bit more from Mr. Spence here. Here's cut number 7. You won't believe this stuff.
I suspect, without having sort of thought it through, that they could focus more attention, in their capacity as overseer of parts of the banking system on the housing sector, whose weakness is a really big sort of sea anchor that's holding the economy back, because that's an important part of most households' balance sheets. So when that's in question, makes them very conservative, and then, kind of takes the wind out of the sails in the economy as a whole.
Oh, so in other words, he wants the Fed to focus on the housing sector to try to reflate the housing bubble, right? Try to get more lending for housing, try to get housing prices up. But wait a minute, isn't that what we did in 2002, 2003, 2004? Wasn't that the solution to the recession back then, was to pump up the housing market? That's what Nobel Prize winner Paul Krugman was advocating. He said we needed a housing bubble. So we all know how poorly that worked. Why would we be wanting another one? In fact, even the interviewer questions him a little bit on that. Here's cut number 8.
So if interest rates are already low, what you mean is the Fed, as a regulator of banks, could encourage banks to lend more for houses? Is that what you're talking about?
Yeah, right. Or inject, in one way or another, capital, with a kind of designated sort of destination, or encourage the regulators to sort of solve these problems about foreclosure and whatnot. I mean, I just think we've been dithering on that front, and it's an important enough component of the problem that maybe the Fed could take a leadership role in focusing attention on it.
So she asks him if he thinks the Fed should encourage banks to make more loans for housing, and he says, yeah. Isn't that how we got into trouble? By the government encouraging banks, incentivizing banks to make loans to real estate that they otherwise wouldn't have made absent those incentives? So has he learned anything from the financial crisis, from the housing bubble? Apparently not. These guys, they're so wedded to this Keynesian inflation ideology that no matter how many times it's proven wrong, they still want to do it. I mean, it's not even like a science, or it's more like a religion. I mean, Keynesianism is like a religion, and you just have to accept it on faith. And it's blind faith, and you have to close your eyes to any contradictory evidence, because I mean, religion is people who are religious on faith. There's no concrete proof. You just believe what you believe. And you're not, if a Muslim tries to tell a Christian that he's wrong and that he should believe in Allah, and he's not going to be open-minded, and a Jew is not going to be open-minded to a Christian trying to tell them to accept Christ. Everybody has their own religious beliefs, and that's their beliefs. And, in science or in math, I mean, people can be open to say, hey, maybe I'm wrong. Show me some evidence, and, I can be persuaded. But the Keynesians, no matter how much evidence you show them that they're wrong, they don't even care. It doesn't even matter, because, Keynes is their God. They worship him. Government spending, that's the deity. They pray to it. Inflation, right? Inflation. In fact, my father used to say that, the Keynesians worship at the altar of inflation, that inflation is their God, but they believe in it. Inflation is so holy that they never actually want to invoke its name. Right? They don't want to say the name of their God, so they come up with different ways to describe it, such as quantitative easing or government stimulus or all different things. I mean, my father had in the biggest con, he called it zigs. He said whenever he looked at all different ways that the government is asking for, or economists want inflation, but they don't want to actually say inflation, but that's actually what they want. But they want to give it all sorts of fancy names. Which is exactly what they did with quantitative easing. But it really is incredible to listen to these guys, one after another, spew out all this nonsense. And when you think about it, what it all boils down to is print money, right? Do you really need a degree in economics to come up with that? I mean, you could tell anyone. In fact, my father, in the original version of How an Economy Grows and Why It Doesn't, his version, mine was Why It Crashes, he had economists as parrots. And their economists were just trained parrots, and all they did was say, print money, lower interest rates, print money, lower interest rates. That's, and basically you can teach a parrot to be an economist, because that's all it takes. They have no real, insight or thought. all they do is parrot back the same old solution to every problem, no matter what it is. And, of course, it doesn't work. Their solutions are the cause of the problem. Anyway, let me grab a quick phone call. On hold is Herman calling from Queens, New York. Herman, you getting ready?
Yeah, I'm not too excited about it. I'm not as worked up as everybody else is. But, yeah, I'm pretty ready. I have I just have two quick questions, and that'll be it. My first question is, what would happen if interest rates actually stayed too high for too long instead of too low for too long? What would the inverse problems be? My first question.
Yeah, well, look, I mean, obviously, you always have a problem when government sets a price. If you set the price too low, you create a problem, and if you set the price too high, you're going to create a problem. Obviously, if interest rates are too high, right, if the government tries to keep interest rates at a level that's higher than what the market wants, everybody's going to want to save. No one's going to want to borrow. So you're going to have a surplus of savings, but you're going to have you're not going to have enough people willing to borrow, and so you're going to stifle the economy that way as well. I mean, you want a price that clears the market. You want a market clearing price where supply and demand meet and set a rate. And if interest rates are where the market wants them, then you have optimal economic performance. You have the right balance between savings and borrowing and investment. But when it's too low or too high, you get problems. But, of course, it's never too high. They always make it too low, so we never really experience the flip side. But anyway, don't go away. I will continue. I know you have some other points to make, so stick around. We've got another hour of the Peter Schiff Show here at Schiff Radio. Welcome back, everybody. Hour 2 of the Peter Schiff Show is underway, and this is Peter Schiff here at SchiffRadio.com. I'm speaking with Herman here in Queens, New York, and I know before the break you had one question. I think you said you had a couple more. What's on your mind?
Yeah, I wanted to know, why is it that these exchanges can be so powerful in terms of the CME and these other exchanges where they can just choose to raise margin requirements for gold and, knock the price down. I think that's what helped knock the price down over $100 in 2 days and whatnot. Is there a free market in exchanges, and why are they so powerful?
Remember, margin requirements are there to protect the exchanges, to make sure that the people who are trading have the capital in case the positions move against them. And they do have a right to raise their margin requirements. In fact, as the price of a commodity goes up, the margin requirement needs to go up, because generally the margin requirement is a percentage of the value of the contract. Think of it like a down payment. If you're going to buy $1 million house, based on normal lending standards, you need to put a bigger down payment than when you're buying a $500,000 house, because, it's a bigger house. So when the price of gold doubles in price, you can't have the same margin requirements as before it doubled, because then it's like having a big reduction. You're controlling a lot more gold. So they have to raise them. Now, as far as the timing of the raises, certainly it makes sense that margins would increase after a big move, or also when you have a lot more volatility. If the commodity is more volatile with bigger swings, then the exchanges would want a cushion of margin. It makes sense. And the last thing we want is the government to come in and say, hey, we don't want those, we don't want those higher margin requirements, because we need responsible speculating. We need to make sure that it's there. So I have no problem with higher margin requirements. Now, could they have a short-term impact on the prices of the commodities that are being affected? Of course, but it's not going to have a long-term impact, and so I don't think it means that the exchanges have all this power to determine the price of gold or silver. They don't. But yes, can they influence the trading in a very short term based on the margins that they set? Of course, but it's nothing that we should be concerned about, and it's certainly nothing that we should look at as some kind of a conspiracy that needs a government correction.
Oh, okay. All right. Thank you.
Sure. Also, this is, I mentioned, I asked Herman if he was preparing for the hurricane. This is the first hurricane that I'm potentially going to go through as a homeowner. And so what does that mean to me now? See, when I was renting my house, if there was a problem, it was no big deal, right? Because I didn't own the property. If there was any damage, all I did is pick up the phone and tell the landlord what he needed to fix. It didn't cost me any money. But now I own this place. If there's any damage, it comes out of my pocket. If some of my trees go down, those are my trees. So it shows you, the pitfalls and the perils of home ownership, right? It's not all, sunshine and lollipops like the realtors want you to believe. When it comes to things like natural disasters, the renters are in much better shape than the homeowners. The homeowners bear all the risks and all the costs. Yes, the renters get some inconvenience, but it's not going to cost them money. Now, maybe if their personal possessions are damaged, all right, but that's not the big ticket stuff. What really gets damaged is the house itself, right? The roof blows off, a tree smashes onto the house and it caves in. The house floods. There's real damage done to the floors, to the walls. That stuff costs a lot of money, and the homeowner, the renter, doesn't have to worry about that. It's the landlord, it's the homeowner that has to worry, and particularly when people are unemployed. There are a lot of people that bought houses and now they don't have jobs. The last thing they can afford is expensive repairs. In fact, I think if a lot of houses are damaged in the hurricane, that just might mean people just decide, you know what, now I got $20,000 or $30,000 worth of damage. Some of it may or may not be covered by insurance, but I got a deductible. I'm underwater anyway in my mortgage. Now maybe I might be underwater literally with a flood. But you know what? Now I might as well just stop paying the mortgage altogether because I can't afford to make the repairs. So why should I make the mortgage payments? And so it's probably going to exacerbate the problems in the housing market by giving people even additional incentives not to pay their mortgages. And what does that mean, of course, when the house ultimately does get foreclosed on and the bank takes over the property? Now it has a property that's in really, really bad shape. And so now more money has to be spent fixing the property back up. So those are even bigger losses for the banks. But anyway, let me go back to the phones. On hold is Eric in Hillsdale, Michigan. Eric, welcome to the show.
Morning, Pete. How are you doing?
Okay, how are you?
Good. Actually, I quickly read through Bernanke's speech, and there's sort of an example of double speak in it. Although he kind of gives off this feeling of a positive outlook, it really seems what he's saying is, God, I've shot all my bullets. I mean, he's extending the open market committee meetings by a day to talk about more policy tools, and just some of the language in there. I don't know. I got a real feeling of fear from him.
Yeah, well, the thing is, the problem is not that they've shot all their bullets; it's that the bullets are now lodged in our chest, and that's why the economy is in such bad shape. I mean, we need to remove those bullets. We need higher interest rates. So the one thing that could help the economy is the one thing we're not going to get. We're going to keep on getting zero interest rates, and so the damage gets more and more pervasive in the economy.
I did actually have two quick questions. One is I've been looking for little mining stocks, mostly in their sort of exploration, which companies I thought would look real exciting to invest in. However, most of these are traded only on the Canadian market, and I just wanted to know how I could find a way as a younger guy who doesn't really know too much about this yet. I'm hoping to learn how to get into that market. And the second one is,
there are a lot of brokerage firms that can give you access to the Canadian markets. Just make sure you're buying direct, that you're not working with the pink sheets. You're buying directly on, Toronto or the Ventures Exchange. You could do it through Euro Pacific Capital, but depending on, we have account minimums now. We used to not have any minimums. We used to let, open up a lot of very small accounts, but because of the high cost of complying with government regulations, we had to impose minimums that are still lower than a lot of my competitors, but we have minimums now, so we don't take the very small accounts because the government has made it so unprofitable to take those accounts that we have to refuse them. But there are a lot of discount brokers now that can get you into the Canadian market.
My second question is, I'm to graduate from college this semester, which is sort of an interesting situation. If not for college, I would have never heard about Austrian economics and gotten into it. On the other hand, I spent all my money on the college. And I'm just wondering, what should I I guess, what kind of firms are looking for free market-minded, people who want to help other families save their money.
Well, I mean, we are. I mean, you can always send me a resume. I mean, at Europac, Pacific Capital, maybe not. I mean, we're being very particular now. But Euro Pacific Precious Metals, I mean, although, I mean, I know we'll be expanding there and looking for good salesmen to sell gold and silver. Or, hey, if you're willing to move to the Caribbean, we're probably going to be hiring soon at Europac International, where that business is really starting to get some traction now. We got 3 brokers there now, and they're really starting to pick up the pace down there. So I'm sure pretty soon we'll be hiring out in the Caribbean. So, hey, keep us posted. I mean, feel free to send us a resume. Anyway, hey, thanks for listening to the show. We will be back, so stick around. There's a lot more coming up. Sorry about that. I was speaking. I didn't even realize I hadn't turned up the volume. This is Peter Schiff. We are back at schiffradio.com. I've got a pretty full board here of calls, and I'm going to try to get to everybody before the end of the hour. Up next, Mike in Hackensack, New Jersey, who's been holding almost an hour. Mike, thanks for your patience.
Thank you. Thank you very much. My question's about gold versus gold stocks. So you're a big advocate for gold stocks, and you think that, because it's not a mania, the price of gold stocks isn't comparable to the price of gold. But my question is that even if everybody jumped into gold stocks tomorrow, do you really think that the gains would be anywhere comparable to the rising price of gold?
Well, if everybody jumped into the gold stocks, I mean, the prices would go ballistic. I mean, everybody can't jump in. Somebody's got to be doing the selling. But, yeah, I mean, I think that if real institutional money moved into gold stocks in a significant way, where typical funds that have no exposure to gold stocks right now, if they just wanted to have 5%, if you had the typical stock market mutual fund wanted to have a 5% exposure to gold stocks, I think these stocks would go ballistic. So, I mean, they're so under-owned right now. I think it's ridiculous. Now, I think at some point what's going to start to happen with these gold stocks is they're going to start raising their dividends. And so that in and of itself will make them more attractive to investors as they're able to translate their higher earnings into bigger dividends. So I think that is what I think is going to come. But ultimately, I think you're going to see a big move up in these stocks. I don't know when. I mean, they're certainly moving up, and they did have a pretty good run from 2000 or so to about 2006 or 2007. That was a pretty good run. Just the last few years is where they've been under so much pressure, and part of that is probably the result of the overhang from 2008. That big decline has got a lot of people scared, and even though we've recouped those losses, it was a big decline, and I think it's kept a lot of people on the sidelines, and I do think a lot of people just don't believe the gold story, and so they're not willing to assign higher multiples to gold stocks if they don't think the high gold price is sustainable,
I think that ultimately, no matter how high or no matter what the potential for the gold stocks are, that ultimately, the same way we've been seeing this maniacal volatility in the markets and how everyone's selling off to, just cash out of the market. I think even with these gold stocks, even if they do go that high, they're ultimately going to get sold because people are going to try to get their hands on whatever cash they can as the market ultimately, in my opinion, crashes.
Yeah,
I think
well,
the stock market is
when we get the real crash that I'm waiting for, people are not going to be trying to get their hands on cash. They're going to be trying to get rid of cash. That is going to be the real collapse of the dollar. And so then it's the opposite. People want to get rid of the cash they have because the longer they hold on to it, the less it will be worth. And when people are trying to get rid of cash in a hurry, what they're going to be trying to buy, in my opinion, is gold and gold stocks and things of that nature. So that's what I'm preparing for. I'm not preparing for the crash where everybody runs to the dollar. I'm preparing for the crash where everybody runs from the dollar. And there's a big difference. And I think the people that fail to prepare for that crash are going to get wiped out. Because in the end, it doesn't matter if you sidestepped all of the market declines and all the volatility, and you've kept a pile of cash under your mattress or in a CD or something. If in the end the dollar is worthless or close to it, the difference between having $1 million and having $100 may be, a few extra sticks of gum. I don't know. So at the end, people's wealth is not going to be defined by how many dollars they have, but by how many dollars they got rid of and what they acquired with them. But anyway, hey, thanks for the call. Next up is Morley in Chicago. Morley, is that how to pronounce your name? Morley?
Yes, that is correct,
okay.
Peter. Peter, my question is, I know you're a big advocate of gold for wealth preservation. What is your take on precious stones, diamonds, and the like?
Yeah, I think that they also make sense to own. They're not as liquid. See, the difference between gemstones and whether it's a diamond or some of the colored stones is, they're not, they're kind of in a way like a numismatic coin in that no two stones are identical. So, you have to look at the cut, the carat weight, the clarity, the color, all these different things that determine what a stone is worth. So you can't just say, hey, I got a 2-carat diamond, okay, well, what's the color? How's it cut? All this stuff comes into play. So it's not like money, like gold, where you have an ounce of gold, you know exactly what it is, and every ounce of gold is worth the same. Every 2-carat diamond does not have the same value. There's a big difference. And then, of course, there's bigger spreads involved between the bid and the ask, so the transaction costs are higher. But, look, obviously, you can have, if you've got a lot of money and you want to be able to put, $10 million into into a wallet size box, you can't do it with gold or silver. You can do it with diamonds if you have the right stones. So, there's a place for them. But it's not something that we're actually encouraging people to do. I mean, if you really want to hedge against inflation, you can buy gold and silver, a lot easier than trying to buy a diamond or even the colored stones. You get into that, it's even more difficult if you're trying to buy, rubies or sapphires or emeralds, investment grades. But I mean, look, I know prices are going up. I mean, I know prices for these stones have been rising. Certainly, if you want to buy one, I mean, if you're looking to buy an engagement ring right now, and you're looking, you're going to have to spend a lot more money to buy that diamond ring than you would have spent a few years ago, because prices are going up.
I had just one more question, or I wanted to express this, but Devin Sharma, who's the CEO of S&P, he quit, I think, last week sometime, and this got very little coverage in the media. And coincidentally, it was right after the downgrade. So I'm guessing, obviously, there was some influence from the government to get rid of him or to force him to quit.
Well, there's been a lot of there's been a lot of pressure put on S&P for the downgrade. And again, the idea is to put enough pressure on S&P to make sure they don't downgrade again, because remember, they left the U.S. on negative watch, and they also want to send a message to the other rating agencies that they better not downgrade. Now, of course, Moody's downgraded Japan the other day. I mean, you don't see the Japanese government, getting all hot under the collar, accusing Moody's of being incompetent, even though, in my opinion, Japan deserves a higher credit rating than the U.S. because we owe Japan a lot of money, not the other way around. They're, the second world's biggest creditor. We're the biggest debtor. It makes no sense that we are a worse risk. In fact, Japan has a printing press, too. So, hey, why don't they claim that, hey, what's the problem? We can print yen. But anyway, it shows how they react. I mean, we know ours is all an illusion. Japan doesn't really care, but we do because we want to maintain the illusion. Hey, anyway, don't go away. We'll be back with another half hour of the Peter Schiff Show, so stick around. Hey, everybody, this is Peter Schiff at SchiffRadio.com. Hey, by the way, the New Orleans Investment Conference is coming up, I guess, at the end of October. Last year it was during Halloween. I don't know if you've ever been to New Orleans for Halloween, but it is quite an experience. But I love the city of New Orleans, and I love the New Orleans Investment Conference. It's probably my favorite conference, especially if you're a resource investor, if you're into gold and silver. So if you've never gone to the conference, or if you have been to the New Orleans conference, definitely come this year. And if you want to sign up, we've got a promotion going through at Schiff Radio. You can sign up through us. not only do you get the discount off of the admission to the conference, but you also get a copy of all 3 of my books for free and a complimentary 6-month subscription, premium subscription to the Peter Schiff Show. So you got lots of extra reasons to go, including spending some time with me and several of the Euro-Pacific capital brokers. We'll have a booth down there, as we always do, so you'll have a chance to potentially meet your broker if you have an account, or meet some of the brokers if you don't have an account, and hang out with me and like-minded people. It is always a very good crowd down there in New Orleans, and, of course, you got the great music and the great food, so a lot of fun at that conference. So be on the lookout for our promotions. Hey, before I go back to the phones, I want to play some sound from MSNBC. Al Sharpton's got a show on MSNBC. They're really developing quite a lineup over there. It's turning into Comedy Central, but I guess it's going to be providing the Peter Schiff Show with lots of material, so I guess I can thank them for that. Anyway, the most recent comedy that we've got a clip of is Representative Jan Schakowsky talking about jobs in the Tea Party. Very interesting. Let me set it up by playing cut number 3.
We ought to be slavishly following those polls that say 3-1 that the Americans think creating jobs is more important than debt reduction right now. And that includes, according to one poll, the Tea Partiers, who by a majority say jobs over debt reduction. People get it. If we're going to reduce the deficit, we better get people working against.
The problem is they don't get it. Yes, we all want jobs, but we're not going to get jobs by running up the debt. In fact, the best way to get jobs, one of the best ways, is to reduce the deficit, because that means the government is taking less money out of the economy, so there's more money to create jobs. And, of course, what we also need to do is stop hampering, undermining, punishing the job creators with regulations and taxes, because then they're not going to create any jobs. But anyway, she's trying to say the Tea Party, because they want jobs, they want the government to spend more money. No, they don't. Anyway, here's the remainder of that, cut number 4.
So my bill creates 2.2 million jobs.
And there are immediate jobs in your bill, Congresswoman. Your bill, the FAST bill, would move right away. It would fix American schools today, create 500,000 jobs immediately.
And not a single dollar would go out that is not attached to a job. So there's built-in accountability in this legislation. This isn't giving a tax break to some business in the hopes that they'll hire somebody. This money goes out to create 2.2 million jobs for each of 2 years at a very reasonable cost that could easily be paid for by taxing what else Americans say, millionaires and billionaires.
There you have it, right? We're going to immediately create jobs by taking money away from the millionaires and billionaires who would have used that money to create jobs, and instead blowing it, on the public schools? We're gonna fix the schools by spending more money? I mean, how much money have we already spent and the schools are broken? Now, are they talking about literally fixing them? Meaning, is this bill about fixing the buildings, about infrastructure, about, maybe building nicer gymnasiums, or I don't know what he means by fix, literally or figuratively. But the way we create jobs is not to take money away from the millionaires who would have used it to create jobs, because by their own admission, when you tax the millionaires, you're not taking the money that they would have spent on consumption. They're still going to buy the things they want. So what you're doing is you're taking away the money that they otherwise would have used to grow the economy. Money that would have been investment capital, money that would have gone to pay for new equipment, to hire a new worker. I mean, you can't hire a new worker if you don't have the money to pay them. And if the government takes that money away, well, gee, I guess I can't hire somebody. I mean, the best way to destroy jobs is to tax the people that create the jobs, to tax investment capital. And that's exactly what she's proposing, to take money away from business owners and send it to Washington, as if that's going to create jobs or prosperity. I mean, it hasn't done it so far. But remember, this isn't a science for these people. This is a religion. And they are going to believe the dogma no matter how many facts are there to contradict them. Anyway, let me go back to the phones. Up next is Dave in Belmar, New Jersey. Dave, thanks for waiting so long.
Yeah, hi, Peter. I was thinking if this storm causes significant damage here, that I'm sure next week we'll be hearing the politicians and the reporters bloviating about price gouging. And I read a couple of articles by Walter Williams after Katrina that really explains why it's so important that the prices change so that the people who need these scarce resources are able to get them. But I would like to hear you address the subject, and if you could come up with a better term for it, like scarcity pricing or something like that. I'm trying to think of a term for price gouging that isn't so prejudicial.
Yeah,
you know?
I mean, when prices go up, it really is, it is a signal. It's a way of rationing resources in times of emergency, so that the people that need them the most are the ones that get them. If all of a sudden there, a lot of people need something. I mean, let's say it's batteries, and there's a run on a lot of people want batteries, and so okay, well, you're raising the price. Well, if I don't raise the price, maybe people will just stock up on batteries they really don't need. Maybe somebody will run to the store and buy extra batteries. But if I raise the price, maybe the people that actually have batteries won't stock up, and so there'll be some more batteries available for the people that actually ran out and really do need them. I mean, you need the goods to be rationed through a price mechanism, because if you don't allow rationing through price, then you have to have rationing through some other way, and then you're going to have either you have people wait in a long line to buy something, or you have you have a lottery, or you have odd or you have different ways. The best way to ration something that's scarce is through the price. Let the price go up, and then people who don't really need it won't buy it, and people who really need it, and therefore the particular good is more valuable, then they're the ones that are going to get it. And also, of course, sometimes when you have real problems, let's say like during a war, let's say there's a war and a particular country is under embargo, and the only way to get goods to the country is to risk, getting shot, and therefore it's very risky to get the goods to the country that's under siege or with a blockade. Obviously, you're going to have to price it a lot higher. And if you're going to say, hey, that's price gouging, we don't want you to come in here and charge so much money. Well, if you make them charge less money, then it's not going to be worth the risk, and then there's going to be no goods available at all, because who is going to run the risk of getting shot, to break through a blockade to smuggle food into the country? So you always have the politicians that want to shoot the messenger. Yes, nobody likes the fact that during an emergency things cost more. But you know what? It's good that they cost more, because if they didn't cost more, they wouldn't be available. There would be a shortage. But the politicians, they just want to make brownie points. They want to score points with the voters, and they want to act like, oh, these gas stations are gouging, everybody's gouging. They're not gouging. The market is working efficiently. And when the government comes in and stops that from happening, then we create a lot of problems. Anyway, hey, thanks for your call. We will be back, the final segment of the Peter Schiff Show. We got a major announcement coming up, so make sure you stick around for that announcement. We will be right back at SchiffRadio.com. Welcome back, everybody. Peter Schiff here. The markets, I guess, seem to like what Ben Bernanke had to say. I don't know. The Dow is now up better than 60 points, about 60. It's the high of the day. The dollar, though, didn't like it. The dollar is going down across the board. The biggest winners are the Aussie and New Zealand dollars, which are up better than 1.25% each. But the euro is also making a big move now, back above 144. Someone just sent me an email. Apparently, Diane Swank of Mesro Financial, she's an economist, another Keynesian. You might remember her. She was one of the people I debated who told us. She asked me, have I been to Detroit lately? She was telling me how efficient and how great the Detroit was. Just before GM and Chrysler went bankrupt and needed government bailouts. But anyway, she's constantly been getting it wrong. But she was on television saying that, hey, Ben Bernanke's a magician. He's going to pull some more rabbits out of a hat, and it's going to help the economy. What rabbits? He's going to pull more money out of his hat, although not really out of his hat. Maybe another part of his anatomy is where he pulls it out. But then he sticks it right up the same part of our anatomy is what actually ends up happening. But the markets are turning around a little bit. Gold, though, gold's up about $12 on the ETF, and silver is kind of hanging out around unchanged, and as are the gold stocks. Anyway, I want to also announce that this is going to be the last Peter Schiff Show on the Genesis network, GCN Radio Network, and I definitely want to thank GCN and Ted Anderson. for the help that they've given us in making this show possible for the months that we've done it here on Genesis. And the reason we're leaving, and the only reason we're leaving, is we want a bigger platform. I want to get on more radio shows, and they just really didn't have the resources to help us grow the show as quickly as we needed to. And so we're moving over to Radio America, and starting on Monday, weather permitting, the show is going to debut on 59 additional terrestrial radio stations around the country, which is good news for the show because it gives us the exposure that we need, or at least the beginning, because ultimately I need to be on 500 shows. And I need the people who are listening to help make it possible. I mean, you got to go to the website and figure out, what these new stations are. If you happen to live in the area, tune in. Tell your friends, your coworkers, family members to tune in. We want to make sure that the stations who are choosing to carry the Peter Schiff Show, we want to make sure that they get an audience, that their advertisers notice some type of pickup, so that will give the syndicators at Radio America a little more ammunition to try to convince other program directors that they too need to carry the Peter Schiff Show. Not all the shows are going to carry it live. A lot of people are going to have it in a later time slot. We're still going to be doing the show at 10 a.m. to noon on SchiffRadio.com. So if you're a premium subscriber, if you're listening directly through our website, nothing will change. But some of the shows are going to carry the show delayed by 2 or 3 hours, and so you can listen to it at that time. But obviously the people who are listening delayed, if they want to call in, they got to call in during the live show, not during the delayed broadcast. Anyway, hopefully we won't have too much hurricane damage. We'll have some power, and we will be able to debut on Radio America on schedule. But anyway, again, thanks everybody at GCN. I wish them well. And, we had a pretty good experience here. Just a couple of hiccups, but other than that, they're a very professional crew, and I thank them for the help they gave us thus far in launching the show. Hopefully we can take it to a higher level as we progress and move forward. Anyway, let me go back to the phones. Next up is Mike calling from Columbus, Ohio. Mike, you're on the show.
Hi, Peter. It's a pleasure to talk to you.
Yes, thanks for calling.
I listened with interest to the interview you did regarding the pawnbroker online, Pongo. I was wondering what other small business models you think would prosper in the coming times.
Well, I mean, there are a lot of them. I think, I think a seamstress, I think a lot of people are going to be, repairing garments, sewing. I think tailors, seamstresses, people that can make things or repair old garments or dress them up, I think that's going to be in demand. I think repair shops in general, TV repair, appliance repair. Right now when something breaks, you just buy another one because they're so cheap coming in from China. But as the cost of new merchandise skyrockets with a collapsing dollar, more and more Americans are going to try to fix what's broken, not buy something else. So any of the repair type of businesses. I also think helping people with home gardens and growing their own vegetables and fruits and things like that. As Americans get poorer and they have fewer employment opportunities, they'll be looking to do more things themselves, including growing their own food so they don't have to go out and buy it. After all, they'll have a lot of free time. They might as well use it productively in a garden rather than just watching TV. So I think that there will be a lot of jobs as we transition to a lower standard of living that will initially be in demand. Hopefully we'll be able to change gears and move into a higher standard of living at some point in the future if we get a real change in Washington, a real change in monetary and fiscal policy. But on the trajectory we're on right now, the only jobs that I see real improvement in are those jobs that benefit from everybody else's misery, everybody else's poverty and declining standard of living, such as my business. I mean, I am specializing in helping people get their money out of the U.S., and so I think my business is going to boom. I would much rather be able to make money encouraging people to bring their money back into the U.S. and invest in the U.S. And other than what I'm doing up in North Dakota in the Bakken, I'm mainly sending money out of the country. But I would much rather have a monetary and fiscal policy that encouraged me to do the opposite. And I am waiting patiently, anxiously for that to happen. Maybe if we could elect Ron Paul and some like-minded congressmen, then maybe we have some more hope in that respect. But anyway, hey, thank you for the call. I want to jump now to Lima, Peru. Fernando, thanks for calling and being patient, listening down in South America.
There, how you doing, Pete? Hey, listen, I've read both two of your books, 2.0 and How Economy Grows and Why It Crashes. And I've got a bunch of friends of mine that I'd like to turn on to, but they don't speak English. They speak Spanish. And I tried Googling your book in Spanish, and I can't seem to find it. And I've heard that your books were translated into other languages.
Yeah, they're in a lot of languages. I mean, they got to be in Spanish. There's got to be a Spanish version of my books. I forget. I mean, there's a lot of Asian and European versions. In fact, my brother is going to be going to Munich, Germany, I think in November. We actually won an award from a German, for a book award for, How an Economy Grows and Why It Crashes. So there are a lot of foreign language versions. There's got to be Spanish. I mean, Spanish is so I'm sure you can find them.
Yeah, how would I go about doing that? Would I have to just go to Google?
Well, I guess local bookstores, or if there's a Latin American Amazon or something like that. I forget. I mean, maybe send us an email. I mean, my brother usually stays on top of these things more than I do as far as all the foreign versions of our book. I mean, there certainly are plenty of them.
All right. Thanks a lot. Listen, also make a quick comment here. I wanted to say that a couple people called up and asked you how they think you would do in the economy if it was a gold standard and we live in a just system. And you seem to always try to play it down, but I want to say, man, I've read your book, man. You're an extremely bright guy, man. And just think, if you lived in that kind of world, Peter, and you didn't have to dedicate all your time to try to straighten people's minds out like you do, teaching us and holding your shows and like your father, you're actually a crusader trying to fight all this unjust system. If you didn't have to do that, you could just focus all your time on looking at the markets and studying businesses and just think how much greater you would be at what you did normally, to make your money.
Yeah, I mean, I'd like to think that my success doesn't depend on America's failure, that if we were doing the right thing, if we had, if I was around, if I had been born, in 1890 or 1900, during the heyday of American capitalism, that I could have still found a way to make money, that it's not simply because I'm living during the demise of American capitalism that I'm able to make money. Yeah, I think I would have been able to find another way to succeed. And believe me, I would much rather be living in a vibrant economy where free market and libertarian thought and the founding fathers was the exception, not the rule. I mean, I would think I would be much happier living in a society where people all thought like me. And that's the kind of country that we used to be, and I kind of envy the people that lived at that time, although I think we have better technology today so we can have a more comfortable lifestyle. But only imagine if we could combine today's comforts and technology with yesterday's ideology and dedication to liberty and free markets. It would be the Jetsons here. It would be a whole other world. But anyway, hey, thanks for listening. Hey, we got a lot of people still on hold. I'm really sorry we didn't get to everybody. Don't forget to tune in on Monday for the brand new Peter Schiff Show live on Radio America and still on SchiffRadio.com. Bye for now, and everybody living in the path of Hurricane Irene, make sure and stay safe and protect your valuables and your loved ones. Anyway, everybody else, have a great weekend. We'll probably have a nervous weekend here on the East Coast. Hey, today is my son's birthday. He's turning 9. Just thought I'd throw it out there.